Hi everyone, it's Stephen here. This one thing can lose you a lot of money, cause you massive aggravation and waste a hell of a lot of time and energy as a commercial property investor. I've been investing in commercial property since 2013, having bought commercial property in the US and the UK. And I'm not too proud to admit that I made this very mistake on my first commercial investment property. It's something that I see a lot of commercial property investors do because on the flip side, there's the opportunity to make a lot of cash flow. So I'll explain to you what the problem is, how you can spot it, how you can lose money if you don't do this one thing, and the 3 simple checks that you need to do before you buy any commercial investment property to make sure that you're not buying a dud. To help you better understand the problem, I'm going to take us back to my very first commercial investment property purchase back in 2013, and I'm going to take you through the numbers and what the deal was, and let's see if you can spot what the actual issue was before I explain exactly what the problem is with this deal. So I bought a 7-year-old fully tenanted commercial warehouse made up of 3 units. Each of these units are called a flex space because what it has is an office and a warehouse. This total warehouse in size was 6,600 square feet, and each unit was around 2,200 square feet, made up of that office and warehouse space. It had 3 tenants in it when I first bought it, but I soon changed those tenants over and got in new tenants, and I got in 2 new tenants that were split across those 3 units. So one tenant had 2 units and the other tenant just had the 1. I agreed to buy this property for $375,000 and I bought it with $75,000 down, which is a 20% deposit. I bought this property on seller finance, which means that the seller carried back the finance for the rest of the money because he owned it free and clear. He had no debt or mortgage associated with the property. Once I stabilised the rents were bringing in $3,600 a month. And there was other expenses associated with this property. So there's property taxes, they're about $5,000 a month. There was also insurance, that was about $4,000 a month. And then there was property manager. I had a property manager in place looking after this. They were charging me £200 a month for that, so $2,400 for the year. So all up, the total expenses were about $15,000 because I was also paying for the water because the water meter was a single water meter, even though there was 3 units there. So what I did is just divvied up the water amount and added that onto the rent. So they're paying slightly more increase in rent because I was paying the water for the tenants. So the cap rate on it was 7%, and how we get to that figure is the net operating income figure, which was about $28,000, divided by the purchase price, which was $375,000. That gives us our cap rate. So then I had the debt. So the debt was being paid back to the seller direct. So that was being paid back monthly at that 5% interest rate over the next 5 years until we had the balloon payment. And that was costing about $940 a month, so about $11,000 a year. And so the cash on cash return with the $75,000 down, with the cash flow that was coming back per month, about $1,400 per month, that was generating around a cash on cash return of 22%. So have you managed to spot it yet? At first glance, it might not be that obvious, but it becomes apparent a bit more when you look at the size of the warehouse. So the warehouse as a total, 6,600 square feet is a good size. But then when you divvy it up into smaller flex spaces, and we've got 3 units in there, it's not a massive size. It's 2,200 square feet. So what type of people do you think are gonna be renting that type of property? It's gonna be mom and pop type businesses. So it's going to be small businesses, starters, startups. So I specifically targeted these types of business because coming out of the global financial crisis, it'd been a couple of years, but things were starting to grow again. The economy was coming back on its legs back in 2013. And these types of startup spaces were ideal to be able to rent quite quickly. They were affordable to people, and so people would jump on them. And that was the reason for picking this type and this size in my thought process at the time. But what I found with these small mom and pop type businesses is they're exposed to cash flow problems. They start paying their rent late. They're difficult to get hold of, and when you agree a payment plan, they don't keep to it. Or they then just will pay a lump sum to kind of make up to where they are, and then they'll slowly start to fall away again and stop paying rent again. And then you go through the eviction process, and then they'll pay a lump sum, and then you decide not to evict them because you're giving them opportunity, because you're not trying to be a crappy landlord. You're trying to do the right thing by people and help their business thrive as well. But there's only so much pain you can take as a landlord when it comes to you're relying on the income yourself, so you can't just keep taking the pain because you've got bills to pay every month no matter what. I had the mortgage to be paid. If I wasn't getting payments for 3 months, that's going to cause me an issue. So the tenants in this particular property were quite complementary because one was a repair shop and the other one had a paint booth and would fix up the repairs. They were really good to have next to each other, so someone could go and get their car repaired and then get it fixed up next door. But these types of businesses were one-man bands typically, and they would just have 1 or 2 employees at best working with them. So, you know, with that comes the natural problems that they're small businesses trying to get going, trying to stay afloat, and your rent is due month after month. And 9 times out of 10, these small mom and pop tenanted properties will have these cash flow issues, and this is exactly what happened with my first commercial investment property. I regularly receive emails about property investor deals hitting my inbox regularly every day, and there's one particular types of properties that I keep getting emailed, and these are industrial properties, and their tenants are these mom and pop style businesses. And to the average investor, they might go, this is a great thing, it's industrial, it's fully tenanted with a 10-year lease, FRI lease, RPI linked, so linked inflation to the rent. And it's got like an 8 or 8.5% yield based on the purchase price, based on the income that's coming in. And people will be thinking, wow, this is a pretty good one. But it's not always the case, because if you look at the tenants, who are the tenants? And they're individual tenants, and you see it's just a person's individual name. So as an example, here's one that came through recently. This one's up for £350,000. Its rent is $29,640 a year with a yield of 8.5%. Now, if we just flick down through this, we can see that it's located in Wales, and this is what it looks like. It's a normal industrial warehouse with rollover doors, hasn't got a great height on it. But when we look down at the tenancies, we can see that the tenants, this particular person, Mr. Adrian Whitcomb and Mr. Gary Cooper. Nothing wrong with these guys. Who knows? I've got no idea about these particular people, whether they pay on time or not. For me, when I see these types of individuals on a tenanted lease, it doesn't matter whether it's a 10-year full repairing insurance lease, whether the rent is linked to RPI or not. All those things disappear when it's an individual, because at the end of the day, if that person decides to not pay, they're not paying. What are you going to do? But unfortunately, those types of properties are only going to attract that type of tenant. That's why it's so important to determine what's the tenant profile that you're trying to aim at when you're looking at an investment property. Even if it's residential, commercial, you need to know what the tenant is that you're trying to attract for your property type. And it's equally massively important when it's commercial property, because you're buying commercial property for cash flow, and you want to make sure that cash flow is coming in all the time. If it isn't, you're up for the business rates after a 3-month period. So it's going to really impact you. So the other issue with these types of tenancies is that the rent's collected month to month rather than quarterly in advance, which is normally on, say, larger commercial investment properties. So in harder economic times, a bit like what we're starting to experience now, where we've got high inflation, we've got high energy costs, everything's costing us a lot more money than it did 12 months ago, everyone's getting impacted by this. And these small mom and pop style businesses are just the same. And they've got it worse because they're paying business rates on top of the rent, on top of the high energy prices that they pay because it's a business, all these extra bills that they have to stump up, as well as their own bills at home. So they've got a lot on their plate, these small businesses. While I'm painting a bit of a bad picture, it's not always a bad picture if you've got the right tenants and the right type of business that is definitely always going to be doing well, and they've got longevity and they've got a proven history of making rent payments on time and all those things. So that's why you need to do these 3 checks before you buy a commercial investment property. So the first thing you need to do is get a copy of the lease, and this is easy to get from the selling agent that's marketing the property. They should have access to the lease and they should be able to give it to you without you visiting or viewing the property. So once you get the lease, you want to check on the lease who's named on the lease. Is it an individual or is it a company? If it's an individual, already it's a bit of a flag. You need to go into additional checks now on that individual. And, you know, do you really want the hassle of being with an individual on a commercial investment property? If it's a business, you can go to Companies House and check out that business. Simply put in the search the business name, and you can see all the accounts history that they've submitted over the years. And from that, you can see how long has their business been established for, what does their accounts look like, you can see the balance sheets and things like that. And it will also give you an understanding of whether there's any credit issues with that particular company. Get a copy of the rental history payments and see if they've been making payments on time, regularly at the time that they should be paying, or have they been missing when they should be paying? Are they always paying late? Have they been paying the late fee if there's one written into the lease? Now, if it's a new lease, there's not going to be much of a rent payments associated with that lease. And some of these properties that I'm seeing are being advertised with tenancies that are only like 3 months old. So what are you going to see in a 3-month-old tenancy? 3 payments, maybe. You definitely hope to have that there. But it's not going to tell you whether they're great, they're a good tenant that pays on time every time for the next however many years you've got that lease with them. Maybe in a 10-year lease and they're 3 months into it. So who's to say whether they're going to be a good tenant or not? The third thing is to find out what the tenant demand is in that particular location for that particular property. So if it's an industrial property, for example, is it on an industrial estate surrounded by other commercial properties, which would likely do better than, say, a property stuck down an alleyway somewhere and it's not very convenient for other locations, hasn't got good transport links and things like that. So depending where that property is, the tenant demand is going to be stronger than other areas where it won't be. Even though it might be tenanted now, you might have big vacancy periods once that tenant goes because it's just not in the right location for where tenants want it to be for that type of property, for those types of businesses. They would operate from those premises. As part of this, you want to find out the rental history for that particular tenants in that property. So if the owners owned that property for quite a number of years, let's say they've owned it for 10 years, so they've got 10 years worth of tenant payments. How many tenants have they had in that time? What's the attrition been like? Has there been a lot of different tenants over that 10-year period, or has it been one tenant for 10 years and now they've renewed and they're still there, which would be a good sign that that property's really performing for that type of tenant and they want to stay there and they've been there 10 years already. But if you found that the tenants keep chopping and changing with a year on, a year off, year on, year off, there's some red flags there that you want to make sure that you're happy with because you can fix the problem, or you look for a next one. Rarely are property investors selling you great deals. So you need to do your due diligence on every commercial investment property that you look at and to determine what the issues are and then whether those issues are acceptable for you, or you've got the skills to remedy those issues and make it into a great commercial investment property for you. But I hope I've given you something to think about when it comes to mom and pop style commercial investment properties. There's a lot of them out there, not all of them are duds, and I'm just trying to make you aware of what to look for that type of style of tenants. So if you're a property investor, you can get £75 worth of credit if you use my link below for property data. You and I both get that £75 worth of credit. There's no additional advantage to me or you. I use property data. I found it great for finding property, analysing property, and understanding everything there is about properties that I'm looking to buy. So thanks very much for watching. I really do appreciate it, and I'll see you next time.